What's up, guys? Welcome back. Today we are going to answer some questions like, why the hell has my order not been fulfilled yet? What is this bid-ask price that everybody's talking about? And even worse, the question I get probably most often in my Discord, why am I only allowed to trade premiums in 5-cent increments? Today I'm going to talk about the bid-ask price and why it really is important for you to know what's going on with the bid-ask price and exactly what it is when you're making trades. It's not really a deal breaker, not something that's going to make or lose you millions of dollars unless you're trading at a super high volume, but definitely something you should understand and know. And I'll even give you some fun facts that you can sound smart to your friends about when they ask you some questions. Let's dive in. Let's look at exactly what the bid-ask price is. Also, I'll answer some questions I got from the Discord so that you guys have a full understanding of bid-ask price. Quick little video tutorial, and then we'll be out of here. All right, guys, so what we're looking at here is an options chain. Now, depending on the brokerage that you're going to use, you're going to see different types of formats, but you're all going to be given the same information. This has an expiration of April 16th. This is a buy option, but we'll see the buy and the sell isn't going to really matter here because in the bid-ask price, they are going to represent both when we're looking at this. Now, we're going to talk about volume and bid-ask spread and all that, but let's first just get an idea of what we're looking at and the things that need to go through our mind if we're going to be started trading options. And guys, also, it needs to be known that bid-ask spreads exist across all of the market. They are not just for options. And this is something I hear, like the people that want to hate on Robinhood, like,
I looked at this brokerage and the price for Apple was here, but on Robinhood it's
guys, there's a bid-ask price even when you are buying and selling stocks, okay? And this is determined by market makers. And what market makers are could be a completely different videos, but essentially they are exchanges that set the price of the bid and the ask, and they might fluctuate depending on the different exchanges. That's why when we buy and sell stocks, we want to make limit orders so that we know exactly the price that's going to be happening, because with this bid-ask price is going on in spreads as well as options, right, there might be some fluctuations from one exchange to another. And the exchange and the market makers that are going to be setting these bid-ask price, that's going to be kind of important to understand what's going on. Okay, so looking at Apple, and I will put up another one. This is considered something with pretty high volume, guys. There's a lot of action that goes on with Apple, okay? There's a lot of open interest. There's a lot of volume. Implied volatility is low. But what we see first is the bid and the ask price, guys. And remember, bid starts with a B. This is where the buyers are. Now, the ask price starts with an A, so that kind of defeats my whole whatever, but this is where the sellers are. And sellers want to sell their product at a higher price. So we have this bid where all the people are, all the buyers are, and ask where all the sellers are. And then we see this little number next to it, guys. This is how many current limit orders are at that bid and their ask price, okay? So that's how many buyers are at the bid price currently, and then there's 395 people at the ask price as well. Now, Robinhood and other brokerages, they'll put something here that's the mark price, and that's kind of right in the middle of the bid-ask price, and that's what you're going to see over here for the premium. But once you click that, as you've seen if you place an option, you get to go in and manually put your bid-ask price. So if we look at that bid and we look at that ask, over here we have $3.95, and over here we have $4. Now, this spread right here of 5 cents is called the bid-ask spread. And every single time an option takes place and is fulfilled, this spread goes off to the exchange. So that's how the exchange makes money for bringing the buyer and the seller together. It's compensation. So we see right now that they get paid according to volume. They want a ton of volume. They want a ton of options to be sold. And the more options that are sold, they can tighten that bid-ask spread and make less money per transaction because they're going to be doing it at a higher volume. And that's how the bid-ask spread is going to breathe. It's going to expand. It's going to contract according to volume. But we'll get to that more in 1 second. So now let's touch on the first question I get all the time. Like, Brad, I place an order. It's not being fulfilled. It's sitting there at 0/1 and it won't be fulfilled. I want it filled. I had it open for the day. It got to the end of the day. It didn't fill. What the hell happened here? Now, what happened there was that you probably placed it at the mark price or somewhere in the middle. And if we want that placed somewhere in the middle, if we are a seller of an option, we have to go closer to the buyer. And what that meant if it was not fulfilled, if you went somewhere here in the middle at, say, $3.98, well, that means a buyer would have to come up to a seller and say, okay, I'll give up a little bit of money and I will come up to you and I'll fulfill it there. And if you are a buyer, you need somebody from the ask side to come down and meet you in the middle. And sometimes that does not happen, especially if there is a large spread. Now this, like I said, is a tight spread. I'll show you one with one that's a little bit bigger. So this one probably wouldn't have that much trouble getting fulfilled at the mark, because we see that really they're only going to lose $2 if they come up to the mark, or $3, 95 to $3.95 to $3.98. If you are selling this option, the buyer would have to give up 3 cents or $3. So if you want an option fulfilled immediately, like right away, if you are a seller, you have to go down into the buyer's side of town. If you are a buyer, you must come up to the ask. And if, like I said, you can kind of figure it out. Maybe you want to try it at $3.98, it doesn't fill for an hour. Okay, you can close that down, restart, place a new limit order, and you could do it like that. But essentially, if you are a seller and you want this filled automatically, you must come down to $3.95 or the bid price. If you place this option at $3.95, it's going to get filled immediately if you're writing and selling that option. If you are the buyer, you must do the opposite. You must come all the way up to $4, up to the ask price. Now, if we look at this, this is where bid-ask spread really can affect us. If I am the buyer and I have to come up to $4, I'm giving up $5 for this trade. If I want to get in and out of this immediately, well, I'm going to come up $5 to the ask, right, to open it. Then if I want to close it, I have to come back down to $3.95. I'm going to lose $10 in that transaction by going up to the ask price and then having to go back down to sell it at the bid price. So you kind of got to watch out for that bid-ask spread and think about, you as a trader, how much are you really giving up to go down to the buyer, or how much are you really giving up to go up to the seller? Let me show you something with a little bit wider bid-ask spread, something with not a lot of volume, and then I'll answer the question of why is this only traded in 5-cent increments. And guys, if you're getting any value of this video, this is not type of content that YouTube likes to promote. Please give the video a thumbs up, leave a comment, let me know if you're getting some from this, kind of push the YouTube algorithm for me and help get these videos out. I'd really, really appreciate it. Let's look at something that has a low volume. All right, guys, so once again, I just want to highlight this. This was $3.95, and this went up to $4. So when I said, if we looked at this bid ask, it was 0.05. So if you wanted to go down and you wanted to come back up immediately to get in and out, that would cost you $10. Not that big of a deal. This has a really, really tight bid-ask spread. But if we look at something like Tattoo Chef with these much smaller limit orders currently, we see the bid price is $1.70. The ask price is going to be $1.95. So we see that this is a 25-cent spread. So if you're the seller of the option and you're going down to the bid price to get this fulfilled immediately, you're giving up $25 to do so. That $25 goes to the exchange, but that's exactly what you do. Now, say you get in and you want to get right back out, or the bid-ask spread doesn't change even over time, because like I said, this will expand and contract due to volume. If you go down at 170, right, you're the seller of this option, then you want to buy to close it later, it's going to cost you $50 to get in and out and in and out. So we have to remember that when we're getting in and out of these trades, where are we going? This one right here is a mark price right here at 183. So if I am the seller of this option and I put it out there for 183, the buyer needs to give up $13 to make this option or fulfill this option for me. Okay, guys, and I want to look at this mark price, because, like, guys, this can be a little deceiving. Don't so much look at that price that's along the side. Think about this bid-ask price, because, like I said, how tight the spread gets, it depends on the volume, okay? The higher volume is going to dictate that. We want liquidity, right? If we have to think about this, we have to think of things that are trading with high volume, high liquidity, because if we want to try and get in and out, it becomes very, very difficult. If you're getting that message, because I get like, Brad, how do I know what's high volume, high liquidity? Well, you see something really close like 5 cents, that's one indicator. But I know in Robinhood, and I think with other brokerages, they say there's a pretty wide bid-ask price. You may not want to go in the middle. You might want to set your own. That's a pretty good indication that that bid-ask price is so big that Robinhood's telling you about it, that you should probably put your own limit price in. That might be an indication that it's going to be hard to get out of this option and get it fulfilled later without giving up too much money to the buyer or the seller. Now let's see how this bid and ask price can artificially change the premium value that you're seeing. Let's say you have a bid price of, say, $1, and then this goes up to $1.50. So right now you'd see the mark on Robinhood at $1.25. Okay, so you place the option, you're like, great, it's got a value of $1.25. Now, if something were to happen, let's say the bid price dropped down to 50 cents and this stayed at $1.50. Well, now what is the option value now? The mark price is now $1. So because volume dropped, the spread got a lot bigger. Now the value of your option dropped by $25 just because of volume. The share price traded kind of flat, kind of even went up, but the volume dropped so much that affected this bid-ask price. So that's another factor that is going to affect the premium of this option. When we go in and we try and close this, we see that really nothing happened fundamentally. This might even be the next day where volume just dropped off terribly, and we can see that there's going to be a 25 difference in that mark or that middle price. So you're kind of going to want to be looking and strategizing. I tend not to go right in the middle. I kind of look at what are these volumes over here. Are there more people at the bid, more people at the ask? And I'll play around. I'll try and place an order, a sell order that's maybe on this side of the mark, and then I'll watch it for a little bit. Maybe I'll get lucky and I'll get a buyer to come up to me. Maybe I won't. I'll cancel that order and I'll start to creep maybe down. And then there's sometimes I want to get in a trade and I know it's going to be like a long-term trade and I know that things are in my favor. Sometimes I'll go down, I'll skip right past the mark and say, I want to get this fulfilled immediately, and I'll go down to the buyer. And that's as a seller. The reverse would be if you're buying the option, you might want to creep up to the mark. And then if it doesn't fulfill, maybe you go to the mark and then you go a little bit further. And lastly, guys, what the hell does this mean? So many times people are trying to get out and they look at that mark price, or like right now, this was for the mark price was at 84 cents. So if you go to place that 84 cents, they say, no, you can't do this. This only trades in 5-cent intervals. Why the hell is that happening? Now, it's a little bit of a long story, but I will shorten it just so you can understand what's going on. And it has to do 100% with the market makers. Guys, before 2001, here's a little fun fact for you. Options were not traded in decimals, in cents, okay? They were traded in fractions. And these fractions, they were the jumps, the spreads that you can make, okay? And the spreads before 2001, the smallest thing that you could do is 1/16 or 6.25 cents. Those were the spreads. Now, this 1/16 was really, really good because, like I said, the market makers, they want volume. The more they make money every single transaction on that spread. So if the spread is 6 cents, they're making $6.25 throughout that whole course of action. Every time an option's fulfilled, that money maker makes $6.25. Well, then 2001 comes along and they turn everything into decimalization, okay? Now, the reason they did that is kind of up in the air. Why did they do that? They say that the rest of the world was doing this in decimals, so to bring in more foreign traders, they wanted to align with what was going on. That was one thing. They also wanted to try and increase liquidity by now saying, okay, we have 6-cent bid-ask spreads. There's only a certain amount of price points that you can have every dollar, but now with 1-cent increments, now we have 100 different price points. Now, why was this good and bad? Well, for the retail investor, it might have been good. It was easier to get in and out of trades at a 1 decimal thing. As time went on, though, the market makers, they started saying, this kind of sucks, especially for small cap, IPO companies, and things like that. It wasn't really good for them because the volume wasn't there. They were trading these really, really small stocks, and they were making the market on these small cap stocks with only a 1-cent spread, so that every transaction they were only making $1, and at a super low volume, that kind of sucked. So there was all these actions put in place around 2011. They started investigating. The people said, SEC, you have to look into this because, for one, the market makers didn't come out and say, we're not making any money. What the market makers came out and said was, if we're not making the market right now and we're not doing any of these for these small cap and these IPO stocks, well, then that's going to lower the liquidity for them more and they don't have a chance to grow. And they said things like when Apple came in, they were small stocks, this, that, and the other thing. And there was these big 6.26-cent spreads, so that the market makers had incentives, right? They had incentives to make the market for these options because they were collecting a lot of money, even at a low volume. So essentially like 2015, 2016, they started to implement, like for these small cap companies, a minimum spread. And what that said was, all right, if we make the minimum spread 5 cents, then the market makers will be incentivized to come back to these IPOs and small cap companies, and that will bring more money to them, and that will bring more money to the company. It would be good for everybody. Now, the retail investor didn't really like this because for the same reason you don't like it, when you see that and you have to make 5-cent increments, it kind of sucks. But is it good for the market? Yeah, it's kind of good for the market because now there's more liquidity for these smaller stocks where it'd be almost impossible to get in and out of something like Tattoo Chef. Now you can because the market makers are there creating that liquidity. So I guess like the short answer is, why are there these minimum increments? The SEC is working to try and even the playing field for the investor, the retail investor, and also the market makers. And by having these 5-cent increments, what that does is it pretty much ensures that the market makers are going to get $5 per transaction, and that's going to be okay with them because they're trading at a low volume. Or stocks like Apple, they're okay with Apple still being at a penny spread because the volume is so high, right? So they only make $1, but they make it hundreds of thousands of times per day, per month, whatever. But now they have these smaller stocks where the volume is lower, so not as many transactions, not as many fulfillments, but they're okay because they're making 5 times their money. So essentially they need 5 times less the amount of volume to make the same amount of money. So that's really it. There is a 5-cent minimum because they want the market makers to be incentivized to set the bid-ask price and make that spread every single time an option is fulfilled. Guys, I hope this helped and I'll touch a little bit about the bid-ask spread, how you can get in and out of orders a little bit more quicker, and why you get that really annoying message. Like I said, if this video did give you value, share it with somebody else that's learning options. Give it a thumbs up. And until I see you guys in the next one, stay positive, work really, really hard. Always, please, I beg you, be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.